Learning Objective 17-3, understand and explain the differences between the various governmental fund types. So let's go through all the different types of funds. There are three basic categories of funds, what's called governmental funds, proprietary funds, and fiduciary funds. And each category of funds, we're going to have detailed of each type. Each category of funds serves a different purpose. With governmental funds, these are not, they don't resemble commercial activities in any way. And really, what they are is, you could call them the other type of fund. In other words, if it doesn't fall into one of the other categories, it's going to be a governmental fund. Proprietary funds resemble commercial activities. And these are things that government does that are like businesses, but not quite businesses, because businesses have owners and they're supposed to earn a profit. Proprietary funds sort of run like a business, and maybe they might even make a profit, but they're still part of the government. They don't have an owner, and they're really there to provide a certain service. So a good example of a proprietary fund would be a snack bar at the park, or a bridge that charges, bridges and highways that charge tolls. Those would be proprietary funds because they're supposed to take money in, and they're supposed to spend that money, in theory, on doing whatever it is they do to collect the tolls or charge and so on. One example I think they use in the book is a local swimming pool. So it costs $5 to get into the swimming pool, and then they have to, they use the money for that, in theory, to take care of the swimming pool, and it should cover the costs of running the swimming pool, because you don't want the local swimming pool to be losing money. So it's kind of like a business, but nobody owns it, and it doesn't have to earn a certain return on investment and things like that. It's just that there is a fee there that they charge to users. So fiduciary funds are situations where the government is charged with holding and managing assets, usually investment assets, that really belong to others. It could be employees of the government, it could be other governments, it could be certain citizens, and so on. So fiduciary would be a situation, again, where the government is responsible for these assets. So if a fund is not proprietary and it's not fiduciary, then it's usually going to be a governmental fund. But what is a fund? A fund is, here's the formal definition, a separate accounting group with accounts to record transactions and prepare the financial statements of a defined part of the governmental entity that is responsible for specific activities or objectives. It's kind of like a mini company within the government. So you could say that there's a piece of the government that's responsible for a certain task, and we're going to kind of create a subsidiary that takes care of it. And we're going to set up that subsidiary with a certain amount of cash and current assets. It may take on some current liabilities, and keep it separately. And we're going to have different funds for all different things. And by the way, it's very important to note that the fund is going to have its own cash. I mentioned that before, but I can't emphasize it strongly enough. Different funds are established for all different purposes. Everything the government does, there's one fund or another that's going to be responsible for this. And the funds are going to have money segregated in them, so you can't take funds from the police department and give it to Parks and Recreation. So each fund is going to have its own assets and its own liabilities, its own revenues and its own expenditures, and its own financial statements. And each situation where we have a fund would be a situation where we want to keep the assets and liabilities separate from other funds. And funds are going to have the accounts are going to balance, of course, with debits and credits and everything. Now, the big fund is called the general fund. You could call it too much fund. And this is the big fund, It has the most activities, most routine transactions recorded in the general fund. And that's everything that doesn't fit into one of the other funds is going to go into the general fund. And we're going to call the difference between assets and liabilities in the governmental funds a fund balance. And if it's a proprietary or fiduciary type fund, we're going to call it the net position. I don't even know why they have the difference in terms, but there is a difference in terms there. Governmental funds, assets minus liabilities will be the fund's balance. For proprietary and fiduciary type funds, it's going to be called a net position. And you'll see there's a difference in the assets and liabilities that we can keep in each one also. So as I said before, we have three types of funds: governmental, proprietary, and fiduciary funds. And there's going to be one general fund, which is a governmental fund, and then many, many other governmental funds for all sorts of different things. Basically, if you're going to have another line item in your budget, then, if you're going to segregate revenues and expenditures, primarily expenditures, for another purpose, then you're probably going to have another fund, another governmental fund to do that. And we have 5 types of governmental funds. You're always going to have a single general fund. And that's where most of the routine transactions take place. And it's pretty much the default fund. If it doesn't fit into one of these other funds, or a proprietary fund, fiduciary fund, it's going to go into the general fund. We also have what's called special revenue funds, capital projects funds, debt service funds, and permanent funds. A special revenue fund would be any situation where the government collects mainly taxes or assesses some kind of tax towards a specific purpose, would be called a special revenue fund. If the government is trying to build something, it's called a capital project fund. If the government is required to put money away to pay debts that aren't in a proprietary fund, it needs to be, the debts are not in a proprietary fund or fiduciary fund, then that would be called a debt service fund. So the debt itself doesn't go into the debt service fund, only monies that have been set aside to pay off debt. So typically what would happen is governments would put money aside into a debt service fund, save it up so they can pay off debt. And permanent funds are situations where assets are locked in for a specific purpose that's set by the government. That's not a fiduciary fund, by the way. And the government has made a decision, or it's been forced from the outside, to only spend the interest on that money. So governments can have multiple ones, multiple different types of funds, usually just one general fund. And so let's talk about the proprietary funds. There's 2 types of proprietary funds. There's what's called the enterprise fund. And these account for operations that are like businesses, like the local pool, a sports arena, municipal utilities, bus companies, all these types of things. Basically, if the fund is charging a fee to users, and then that fee is expected to offset the cost of the service, you have an enterprise fund. And it's not a company because the government owns it, not people, and it doesn't exist to make a profit. It exists to provide a service to society or to the local area. And that's what would make it an enterprise fund, which would be one type of proprietary fund. An internal service fund is like an enterprise fund, except the customer is within the government. So what the government here is doing is it has a fund that in essence provides a service to other funds. So a good example of this is municipal motor vehicle pools. They have one fund that's responsible for all the cars. So the city has, let's say, 150 vehicles, and they have an internal service fund called the motor pool. And the motor pool is responsible for taking care of all these vehicles, and then it charges a fee to the other funds for doing so. So if the police department has 30 police cars that are maintained by the motor pool, then the motor pool is going to take care of those police cars, and then it's going to charge a fee to the police fund or to the general fund on behalf of the police fund. We also have what's called fiduciary funds. And fiduciary funds, there's two types of these, what's called trust funds. And these would be situations, these are the most common, where the government is responsible for holding investments on behalf of others. So one could be pensions and employee benefits. They have assets in there to benefit their employees. Investment trust funds, for people actually invest money, or the government requires that people invest a certain amount of money in one of these investment trust funds, or what's called private purpose trust funds that don't actually benefit the government unit, but the government's still responsible for taking care of it. And agency funds are usually quick transfers between different governments or different entities. So if the government collects money on behalf of another government, typically that money would be placed into an agency fund and then dispersed out fairly quickly. So here you can see more specific definitions. Figure 17.1 goes into more specific definitions of all the different fund types. Here you can see formal definitions of the special revenue funds. And proceeds are specific revenue sources restricted for specified purposes. An example of that would be if you had, you may see sometimes what's called enterprise zones. And sales tax charged in an enterprise zone can only be spent within that zone. So the government collects the money into a special revenue fund, and then it's restricted in how it can spend the money. Capital projects, again, would be for construction. Debt service is when you set aside money for paying off debt. And a permanent fund would be resources restricted so that the principal cannot be spent, only the earnings. And it would be some situation where the money is spent to benefit the government or the people in the area or something like that. That's how it's going to be somewhat different from the trust fund. Enterprise fund, internal service fund. This figure 17.1 is pretty handy to go through what all of these different things are.